Welcome to The Emotional Investor, where we'll explore the powerful role emotions play in investing and how letting your feelings take control can lead to costly mistakes. Investing can be an emotional roller coaster, but it's a ride you don't have to endure if you learn how to separate your emotions from your strategy. Let's begin by acknowledging one simple truth. Everyone experiences emotions when they invest. Whether it's excitement, fear, greed, or panic, emotions are natural. However, when emotions dictate your decisions, you're not investing anymore, you're gambling.
Picture this: you've just heard that the stock market is reaching all-time highs. Everyone is talking about how much money they've made. Your friend, your neighbor, your co-worker. Everyone seems to have doubled or tripled their investments in a matter of months. You begin to feel excitement and maybe a little fear too. Fear of missing out, or FOMO, as it's commonly called. You think, if I don't get in now, I might never have this chance again. So you buy in. But here's the thing, by the time you've heard all this hype, chances of the market is near its peak.
That's right. It's easy to get caught up in the excitement and the fear of missing out, but reacting to the hype can lead to poor decisions.
This is one of the most common mistakes new investors make. They jump in based on the emotions of excitement and fear, rather than based on analysis or a long-term plan. And what happens next? The market turns, prices drop. Your excitement turns into fear of losing all the money you just invested. Suddenly, that once-in-a-lifetime opportunity doesn't feel so good. You panic, you sell, you've locked in your losses. You've bought high and sold low, the exact opposite of what you're supposed to do. And all because emotions were in the driver's seat.
Let's take a step back and think about why emotions are so powerful when it comes to investing. When you see a stock rising, your brain releases dopamine, the feel-good chemical. It's the same feeling you get when you win a game or eat your favorite food. You crave that feeling again, so you keep chasing those rising stocks, hoping to catch the next wave. This is what we call greed, though it may not always feel like greed at the time.
On the flip side, when the market starts to fall, it triggers fear, an instinctive, survival-based reaction. It's your brain telling you to get out before you lose everything. This is where panic sets in, and this panic often leads to selling at the worst possible time.
So why does this happen? Why are our emotions so bad for investing? Well, investing requires you to think long-term. Stocks go up and down, markets fluctuate, and there will always be periods of both growth and decline. But emotions? Emotions are short-term. They're based on how you feel right now. And that's the problem. Emotions focus on immediate rewards or avoiding immediate pain. Remember to keep your emotions in check and think long-term for better investment outcomes.
Let's break this down further. One of the biggest emotional traps for investors is fear of missing out, or FOMO. It's that nagging feeling when you see others making money and you think, why not me? You feel pressured to act quickly because you don't want to miss the boat. But FOMO almost always leads to poor decisions. When you invest because of FOMO, you're chasing trends, not value. And when you chase trends, you're buying when stocks are expensive, right when they're about to fall.
Another common emotional trap is greed. Greed whispers in your ear when you see your investments rising, telling you to keep holding on for just a little more profit. It makes you ignore the warning signs of an overheated market. You convince yourself that this time is different, that the market will keep going up forever. But nothing lasts forever. When the bubble bursts, greed can quickly turn into regret, and regret is another emotion that clouds judgment.
Then there's fear, a powerful emotion that often paralyzes investors. When the market drops, it's normal to feel fear. You see your portfolio shrinking and your instinct is to protect what you have left. But acting out of fear often leads to selling at a loss. Fear convinces you that the market will never recover, even though history shows us time and again that it almost always does.
Think about the market crash of 2008. During the height of the financial crisis, many people sold off their investments in a panic, locking in their losses. But those who stayed the course and held onto their investments eventually saw the market rebound, and many of those same stocks reached new highs in the years that followed.
So, how do you overcome these emotional traps? How do you keep your emotions in check when investing?
The first step is to have a plan, a well thought out strategy that aligns with your long-term goals. If you have a plan, you're less likely to make impulsive decisions based on short-term market movements.
A solid investment plan takes into account your risk tolerance, your time horizon, and your financial goals. Are you investing for retirement, which is 20 or 30 years away? Or are you looking to buy a house in the next 5 years? Your plan should reflect your timeline and risk tolerance, not the market's daily fluctuations. Once you have a plan in place, stick to it. This is easier said than done, but sticking to your plan during periods of market volatility is key to long-term success.
Another way to keep emotions in check is to diversify your investments. Diversification is like spreading your bets across different asset classes, stocks, bonds, real estate, and more. This helps reduce risk because you're not putting all your eggs in one basket. When one part of your portfolio is down, another part might be up, which can help smooth out the emotional highs and lows of investing.
And finally, don't forget the importance of patience. Investing is a long-term game. It's about building wealth over time, not overnight. Patience allows you to ride out the market's ups and downs without getting caught up in the emotional swings that lead to poor decisions.
Let's summarize. Emotions are natural, but they're not a good guide for investing. Excitement leads to overconfidence, fear leads to panic selling, and greed blinds you to the risks. The key to successful investing is to recognize these emotions and have a strategy in place that allows you to stay the course no matter what the market does.
The good news is you don't have to be a slave to your emotions. With a plan, diversification, and patience, you can control your emotions rather than letting them control you. And when you do that, you put yourself on a path toward long-term financial success.
So next time you're tempted to buy into the hype or sell in a panic, remember, investing is not about how you feel today. It's about where you want to be tomorrow. Thank you for joining us today in this journey through the emotional side of investing. Stay calm, stay focused, and most importantly, stay invested for the long term.
Remember to like and subscribe for more video content. Sapiens quae vigilat.